The financial market can be a dangerous game. On the one hand, there are opportunities that can transform your life. On the other, the risks that can destroy your dreams. When the market starts to oscillate, what is your reaction? Maybe panic takes over, doubts grow, and you ask yourself, am I doing the right thing? But what if the real key to surviving these storms lies not in avoiding volatility, but in understanding it deeply? Why do some investors seem immune to chaos, while others succumb? How can you turn volatility, which terrifies so many, into your greatest ally? We'll unravel the secrets behind this conundrum, and who knows, change the way you view the market forever. Understanding volatility is like unraveling the beating heart of the financial market. Imagine a rough sea, where the waves represent the fluctuations of asset prices. Every move, every oscillation, is a response to an external stimulus. Whether it's a change in economic policy, a technological innovation, or an unexpected geopolitical event. But here's the secret. Volatility, as intimidating as it sounds, is inherent to the market. It is not an enemy, but an intrinsic characteristic that, when understood, can be your ally. Knowing that storms are fleeting and that the market, over time, tends to stabilize, allows you to navigate with more confidence, without getting carried away by the waves of panic. However, many investors, especially less experienced ones, fall into the trap of reacting impulsively to these swings. They see a sharp drop in prices and, in an almost instinctive reflex, sell their assets down, fearing larger losses. This is a classic mistake that can be costly. Volatility, contrary to what it seems, is not an indicator of impending disaster, but rather a manifestation of the dynamic nature of markets. What may seem like a collapse today may just be a temporary correction, a disguised opportunity to strengthen your portfolio. Enjoyed this content? Then don't miss out on the other videos on my channel. I'm sure you'll find something that catches your interest. And if you haven't subscribed yet, make sure to hit that subscribe button and turn on notifications. That way, you'll stay updated with all the new content and help the channel grow even more. I'm counting on you. So, as a well-informed financial strategist, the tip is clear. Embrace volatility with understanding and strategy. Think of it not as a warning sign, but as a tool that can be used to your advantage. This requires patience, study, and above all, a clear vision of your long-term goals. When you understand volatility and how it operates, you position yourself to make more informed and less impulsive decisions, turning what many see as a market weakness into its greatest strength. An investment plan is more than just a list of assets. It's the map that guides your every step into the financial world, protecting you from the emotional traps that come with volatility. Imagine a scenario. The market starts to plummet and panic spreads. Without a plan, you'd be tempted to follow the herd and liquidate your investments. But with a solid plan, you have an anchor. You know that your decisions were based on a well-thought-out strategy that aligned with your long-term goals. This security allows you to stay calm while others panic. Creating an effective investment plan is not a simple task. It requires a clear understanding of your financial goals, your time horizon, and crucially, your risk tolerance. Each of these elements should be carefully considered and reviewed regularly. The plan should be flexible enough to adapt to changing personal circumstances or market conditions, but rigid enough to stay the course when the waters become turbulent. It's this framework that prevents impulsive decisions and ensures that you stay on track regardless of market fluctuations. In addition, a well-structured plan should include an emotional component. This is where many investors fail. They don't consider how they will react emotionally to volatility. Incorporating an understanding of your financial behavior, perhaps through simulations or stress scenarios, can make all the difference. When you predict your reactions and prepare them in advance, you become more resistant to panic. Ultimately, an investment plan is key to successfully navigating the market, as it not only guides your choices, but also strengthens your emotional resilience in times of uncertainty. Diversification as protection. Diversification is the art of not putting all your eggs in one basket. In the investment world, this means spreading your resources across different asset classes to mitigate risk. Think about it. If you invest all your money in shares of a single company, the fate of your portfolio is intrinsically linked to the fate of that company. If it prospers, you prosper. But if it fails, you can lose everything. Diversification, on the other hand, distributes this risk. By investing in a variety of assets, stocks, bonds, real estate, commodities, you protect your portfolio against the extreme volatility of any specific industry. But diversification goes beyond simply owning different types of assets. It's about understanding how each of these assets behaves in different market conditions. For example, while stocks can offer high returns in bull markets, bonds can provide stability in times of uncertainty. Similarly, investing in international markets can protect your portfolio against country-specific risks. The key is to find the right balance, where gains in one area can offset losses in another, creating a portfolio that not only survives volatility, but thrives in it. However, it is important to note that diversification is not a silver bullet. It does not eliminate all risks, but it manages them more effectively. To maximize the benefits of diversification, it's crucial to regularly revisit your portfolio and adjust your allocations as your goals, risk tolerance, and market conditions evolve. A diversified portfolio, adjusted wisely and strategically, not only protects against the inevitable market fluctuations, but also puts you in a stronger position to achieve your financial goals over time. Emotional control. In the whirlwind of the market, maintaining emotional control is a skill that can separate successful investors from those who fail. When markets fall, fear sets in, and it's natural to want to protect your capital. But here's the problem. Impulsive decisions, based on fear or greed, often lead to disastrous results. Remember that the market is cyclical. What goes down often goes back up. Therefore, staying calm during financial storms is crucial. Emotional control allows you to see beyond the immediate chaos and make rational decisions based on data and long-term strategies rather than momentary emotions. An effective way to maintain emotional control is to establish clear rules for your investment decisions. For example, you can set loss or gain limits for each investment. If an asset falls or rises beyond a certain point, you take a predetermined action, such as selling or holding. These rules, established in times of calm, help remove emotion from the equation when the market is in turmoil. Another method is to avoid constantly tracking market prices, which can amplify emotions. Instead, do periodic check-ins and stay focused on your long-term goals. Additionally, understanding your own emotional tendencies can be a powerful tool. We all have emotional biases, such as loss aversion or exaggerated optimism, that can influence our investment decisions. Recognizing these biases and developing strategies to mitigate them can help maintain emotional control, even in the most difficult times. Ultimately, successful investing is not just about choosing the right assets, but also about managing your emotions in a way that they work for you rather than against you. Thinking long-term in the investment world is more than a strategy. It's a mindset. In a market where daily news and price fluctuations can easily be distracting and worrying, maintaining a long-term perspective is essential for success. When you look at the farther horizon, the daily highs and lows become less relevant. Instead of being put off by a temporary slump, you focus on sustained growth over the years. This long-term mindset not only protects you against volatility, but also allows you to take advantage of growth opportunities that come with time. Building a long-term vision requires discipline and patience. That means resisting the temptation to try to time the market, which is notoriously difficult for even the most experienced investors. Studies show that those who try to enter and exit the market based on short-term forecasts often miss out on the best opportunities for gain. On the contrary, staying invested over time, despite market fluctuations, often results in better returns. That's why successful investors aren't those who react quickly, but those who have patience and confidence in their long-term strategies. In addition, thinking long-term implies a proactive approach to managing your portfolio. This includes regular reviews to ensure that your financial goals are still aligned with your asset allocations. As you move forward in life and your circumstances change, adjusting your portfolio to reflect those changes is crucial. In summary, a long-term mindset is key to successfully navigating the world of investing. Not only does it help mitigate the impact of volatility, but it also positions you to reap the rewards of your financial decisions over time. When the market shakes up again, what will be your next move? to stand still, paralyzed by fear, or to take advantage of the opportunity that few see. Volatility is not the end, but the beginning of something bigger. But are you really prepared to turn the tables in your favor? How will you turn these challenges into victories? The answer may be closer than you think, but only those who look beyond the obvious can figure it out. What will define your success?